Hi guys, it's Trader Michael here and welcome to Litefinance Broker YouTube channel, where we upload videos about the trading strategies, tutorial videos and all kinds of educational videos, of course trading related. So do follow the channel and check us also on Instagram and TikTok. And going further with the video, today's topic is the Wicks, trading with the Wicks. So I will dig down what are Wicks and how you should trade them, because most of you most probably know that the Wicks are signs of weakness of the market. So we will check that theory and see how it goes in the practice. And we will talk about, all the details. So let's go straight to the chart and see what we got. And let's debunk the theory about the Wicks. So firstly, I have the chart on Australian dollar against the Canadian dollar, the daily time frame. And first, what we should take into account when looking for the Wicks is the time frame, which means you should only look for the Wicks on higher time frames. Why, you ask? Well, firstly, it is because the range that we have. When you have even a long wick on a smaller time frame, it can have 10 pips, 15 pips. So that means it wouldn't be a very, we can say, a profitable trade or even worth noticing idea to trade along with it, because let's face it, 10 pips, it's if you take into account that you need to, for example, risk to set your stop loss double that, it's not a good business. So that is why you should pay attention only to the Wicks on higher time frames, because the Wicks can have even 50, 70, 100 maybe pips. So let's for example check this one right here. This one has 220 pips. So for example, I think this one is worth checking it. And okay, first thing that we need to, from what we need to start is to the first rule, that the wick should be at least more than 50% of the whole length of the candle, which means if the wick should be, in this example, when we check this candle, once again, price, let's check this whole candle. This candle has in total 270. And if we see that the wicks have more than 135, that means it is our good example to to analyze and to determine whether it is worth checking, worth trading. Okay, so if we know which candles and which wicks we should be looking at, next let's determine which wicks are good to trade and which wicks are not good to trade. Which wicks will be filled and which wicks will most likely, of course, will not be filled. So let's talk about strong resistance and trading in the zone. So the wicks that most probably will not be filled are those who are made on top of the strong resistance. So for example, if we have the situation, I have some things marked on the chart to have a good to come back to them and to talk about them later. So, and now let's let's focus on the things that I'm talking right now, which are the strong resistance and support zones. So, for example, we have the situation like here. If we have in this zone very strong resistance, it was once, twice, 3 times, 4 times, 5 times, 6 times tested. And if we see, for example, candles like here, we have rejection. Let's zoom it maybe. We have rejection, 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 again rejection, and candles with a very long wicks to the upside. That means that something is going on here, and the price really can't go higher than those levels, than this particular zone. Even right here, if you can see, even it was made a little bit higher, but the same situation. Wick to the upside, long wick to the upside, long wick to the upside, doji, almost again doji, strong wick to the upside, wick to the upside. It again signed a weakness. It was also, if we could, extend this rectangle, it was also in this particular strong zone. Here, of course, the market, showed us a little bit of strength, but even though it wasn't enough to push the price higher. And we saw rejections after rejections. So if we have a very strong, in this situation, resistance, and the price wants to go higher, like here, like here, like here, and we see wicks, that is the moment where most probably the wick will not be filled. When the price and the wick is basically showing a weakness of the market. Next example. Again, very strong zone. We're coming here, wick, wick. We're coming here, going down, going up, wick to the upside, wick to the upside. Again, showing the shows the sign of weakness. So basically, these are the moments. If you can check to the downside, from the other side, from the support, here the same situation. Let's zoom in, and you can see wick to the upside, wick to the upside, to the downside. I'm sorry, to the downside, again to the downside. That is a clearly market weakness, which is the indecision, where they are trading in this zone, and either they don't have enough buying power or selling power to go to the upside and go to the downside, either direction. Here is also a good example. If we have strong zone like here, you need to check the left side. We have here points, here the price was stopping by. So that means for this particular case scenario, this is a strong resistance zone. We have a wick, so most probably that is a fake move, and the price will reject it. So that is the first case scenario where the wicks are most probably will not be filled. The second case scenario where wicks will be filled is when the wick is being created inside particular range, inside particular zone. So if we zoom out, if you have wicks from this moment to the upside, around this zone, or from this moment wicks to the downside, inside this whole range, that means that most probably it will be filled. If it is not inside some, if it is not on top of some support, or below some strong resistance. So let's go for a particular next examples. Okay, so maybe let's talk about this no bueno zone. So basically, this is the zone where you should don't trade in this particular situation. And you ask why? Well, because you see that here we have big candles with big bodies, which means that there is a high volatility and strong indecision in the market. So basically, the big players doesn't know which direction they want to go, and they are, we can say, fighting with each other who has the more money in this particular situation, and who will show the strength on the market. So basically, during such times, it is better to wait. Either the price will go below that, or above that zone, and create some kind of confirmation, depends on, of course, a particular strategy you use to get into a trade. So again, let's go for the scenario which we talked about in the beginning. Or no, we have situation also right here. Strong rejection because we have a falling market. Here, this move created for us, again, the very strong resistance zone, but it is also confirmed on the left side. When you go to the left, you see that this area is a very strong area where the price bounced from it many times in the past. So that would indicate just a simple fake move. This one is a particularly good example to showcase which wicks most probably will be filled, because it was made inside of a very, very we can say tight range. We could argue that here it was also a support in this situation, but we can see from the overall market structure that the trend is bearish. So that is why in this situation all wicks to the downside most likely will be filled. It clearly has more than 50% of the whole candle length. So yeah, it fits our specifications which we talked about in the beginning. So now let's go further with the charts and see other examples. Oh yeah, we have this one from the beginning. Let's zoom out, and again we have the situation that we see that this is a falling market. We have the even confirmation here that this is a strong move to the downside. We have strong rejection, but still there were lower prices very not so long time ago, and the overall market structure, the trend is still falling. So basically what you should imagine that this move creates strong move down to the downside and a retest and then continuation. So basically you could imagine if we go to the lower time frame, which I will not do because we will lost this moment of time, but basically you can imagine that if we go to the lower time frame, it would look like this, and you have here the continuation. So these are the two case scenario, which means that the wicks will be rejected most likely when they are in the opposite direction. Excuse me, when they are in the direction of a strong resistance or support, which means like this situation, etc. Or even if we would have seen a wick to the downside here, because if we would scroll down, zoom out, we would see, of course, again that this is a strong support zone. Let's zoom in again. And the wicks that most likely will be filled are those that are along with the trend and are created inside the price range. So they are not on the strong resistance or strong support. So the basic conditions we have discussed, and as you probably deduct from the examples and the chart that we are looking at, that basically you can't trade solely depends on the wicks, because if you need to calculate also the risk reward ratio. Maybe this example, let's delete that. Maybe this example is not the best one to showcase that, but let's measure the potential risk-reward ratio in this situation. So basically, classically, we could do something like this, that when we went back to this moment, we could enter even here, and we would have 290 pips to gain. And let's check where we could place our stop loss, 190. So more or less it would be 290 3-to-1 risk reward ratio, almost. But for this is not the best example to showcase that, but for in other examples, maybe let's delete that and measure separately other examples. But let's check, for example, this one, right? The wick has 59 pips, and where we could place our stop loss here, 135. Not good risk reward ratio. So basically the wicks should be treated more as an indicator, not as a pure solely strategy. Because when we see situation like here, okay, we have the good risk reward ratio, but for most of the time it will not be so great. So in most cases you will have to treat it more as an additional confirmation or a trade idea for the direction of the movement, for the direction of the trend, for a confirmation, rather than a pure trading strategy to put your calculations in and calculate your potential stop loss or take profit. Because as you saw, the risk reward ratio will not be great. Even here, if we calculate it in this situation, we have candlestick chart pattern, we have the downside move, we have the wick to the downside inside the zone. So let's check it. The wick has 66 pips, and to the upside where we could place our stop loss, one moment, it has 70. So it would be 1-to-1 risk reward ratio, even less than 1-to-1, because we would have to add the spread and commission, and I always add additional 1 point to have the margin for error. So maybe again, let's summarize all the conditions for the wick to be considered into our analysis. First thing is that it needs to be on a higher time frame. The candle needs to be on a higher time frame, which means daily, weekly, or even monthly if we have such a situation. Second thing, the wick needs to be at least 50% of the length of the entire candle. Third thing is that we need to check where it placed on the chart. So we need to have the background for this particular situation. Either we are dealing with the wick which will be filled, or which is not to be filled. And yeah, that would be basically all for this video. Hope you learned something from it. And if you do, just subscribe for more. Follow us also on the Instagram and TikTok. So till next time, guys. Thanks for watching.